Hey everyone, and welcome to another deep dive with us. It looks like today we're going to try to make sense of all the market craziness happening,
Yeah, definitely lots going on.
especially with Tesla. I mean, its stock is all over the place.
Oh yeah, that autonomous vehicle situation is really throwing a wrench in things. It could be
Yeah.
game changer. Who knows?
And then on top of all that, we've got inflation still hanging around.
Like that guest that just won't leave.
Exactly. It's a lot to unpack. And then we also wanted to see what a legend like Stanley Druckenmiller is up to in all this.
Yeah, what moves he's making.
How's he navigating this crazy landscape? Our sources actually included some of his latest portfolio moves so we can get a glimpse into that brilliant mind. It's going to be fascinating.
Oh, for sure. And, it's not just about what's happening,
Right.
like Tesla going up or inflation going up. It's about why.
Exactly.
Why these things matter for your investments and your money.
Okay, so speaking of the markets, they're not exactly giving us a clear signal today.
No.
We've got the NASDAQ up a little bit, but the Dow Jones is down.
Yeah, that's interesting.
Then you've got some sectors like energy and communication services.
Yeah, just doing their own thing.
Totally.
It's kind of a mixed bag, isn't it?
It really is.
Yeah.
What do you think's going on there?
Well, I think part of it is just leftover anxiety from last week.
Oh, you mean with the inflation worries?
Yeah,
Oh.
and the Fed, everybody got spooked that they might overdo it with interest rates.
Right.
Remember, the S&P 500 had a rough week, down 2%.
Oh, yeah. It definitely took a hit.
And that was after the election bump even.
Yeah. So what does that tell us?
Well, on top of that, you've got Treasury yields creeping up.
Uh-oh.
They're getting close to 4.5%.
Which means?
Make stocks look a little less appealing.
Oh, right. Less attractive when compared to those safer options.
Exactly.
Okay, so I've got those jitters, but also can't forget about the new administration.
Right, they're settling in,
Uh,
shaking things up a bit.
yeah, some are calling the cabinet appointments disruptive, which
Yeah.
probably has folks in certain sectors a bit on edge. Healthcare, government contracting.
True, but change can also bring opportunity.
Right. Some would say it's all about perspective.
Exactly. In fact, Tom Lee over at Fundstrat,
Oh, yeah, I know that name.
he's got a pretty solid track record.
He does.
Well, he's actually predicting that things will smooth out a bit once we get past some of the short-term uncertainties.
What kind of uncertainties are we talking about?
Well, for example, NVIDIA has their earnings report coming up,
Mhm.
and there's the whole question of how the new administration will approach fiscal policy.
Right, so we just need a little more clarity.
Exactly. And then history shows that markets tend to recover after elections, once the dust settles and things become a bit clearer.
So it's like that saying, this too shall pass.
Pretty much. I'd say little cautious optimism is definitely warranted.
Okay, I like that. Cautious optimism. But we've got to talk about Tesla.
Oh, yeah, because that stock went absolutely nuts today.
Seriously, through the roof.
Huge surge. And there's a reason for it. More than just hype this time.
Lay it on me.
It all ties back to those rumors about the new administration and autonomous vehicles.
Right. There's talk they might push for federal regulations.
Yeah.
Which, I mean, if that happens.
Big if.
Yeah, but if that happens, wouldn't that be huge for Tesla's self-driving tech? Their FSD program.
Oh, absolutely. It could completely change the playing field, give them a major edge over companies like Uber and Lyft. Their stocks actually went down today.
Wow, so like a seesaw.
Exactly. One goes up, the other goes down.
Wild. But shouldn't we be pumping the brakes just a tiny bit?
Yeah, I mean, it's still very early.
Right, these are just rumors at this point. And, the whole self-driving car situation is still a bit of a mystery.
Oh, yeah, like, will they even need steering wheels anymore?
Right.
Who knows?
Lots of what ifs.
Yeah, so much uncertainty. And, this is where investors can get into trouble. Buying the rumor, selling the news.
Oh, right. The stock jumps on speculation, but then can plummet when the actual news comes out.
Right, whether it's good or bad. And let's not forget, Tesla is known for being volatile. Lots of ups and downs.
That's for sure. And they've got a ton of debt.
Oh, yeah, and plenty of controversy surrounding the company. So, yeah, buckle up.
Speaking of things that can make a portfolio feel like a roller coaster, inflation. And we got this new report from the San Francisco Fed.
Oh, yeah, I saw that.
It's basically saying, hold on a sec, we're not out of the woods yet.
Yeah, they're throwing some cold water on the idea that inflation is under control.
What are they seeing that's making them so worried?
Well, the main takeaway is that excess demand is still fueling inflation, especially in the labor market.
Oh, interesting.
They're even backing it up with some pretty compelling data.
Okay, so what kind of data?
Well, they're looking at things like the vacancy to unemployment ratio
Hmm.
and the vacancy to job seeker ratio. And basically it's showing that even though everyone keeps saying the labor market is cooling down,
Mm.
there are still way more jobs than people to fill them,
So still a worker shortage.
pretty much. And that mismatch, all those unfilled jobs, it's actually adding zero point 0.3 to zero point 0.4 percentage points to inflation.
Oh, wow. That's not insignificant.
Nope, it's real money compacting everyone's wallets.
And you know what's crazy? This goes against what Fed Chair Powell has been saying.
Oh yeah, he's been downplaying the labor market's impact on inflation.
Right, but this report seems to be telling a different story.
Yeah, it does make you wonder if the Fed might have to rethink things a little bit. Their next move.
Right, like will they hike rates again? Are we heading for a recession?
$1 million questions. Nobody has a crystal ball, unfortunately. But there are some glimmers of hope, I'd say.
Oh, okay. Tell me more.
Well, for one, housing inflation seems to be easing up a bit.
Really?
Yeah, that's been a major pain point. But recent rental data suggests things might be calming down.
Well, that's good news.
And the labor market is cooling down, too, even if it's happening slowly.
So maybe things aren't quite as dire as they seem.
It's possible. Things to keep an eye on are the Employment Cost Index
Okay. The ECI.
and job openings. Those are key indicators for the labor market. And here's something interesting to consider. A cooler labor market could actually be a positive thing for corporate earnings.
How so?
Well, if companies have to pay less to attract and retain workers.
Well, right. Their costs go down.
Exactly. And that could boost profits.
And happy investors.
Right, and that could give the stock market a boost too.
Okay, so we've got Tesla on its wild ride, inflation throwing us curveballs. Let's see what a legend like Stanley Druckenmiller is doing in all this.
Yeah, his moves are always fascinating to watch.
I mean, the guy's a genius. And
Yeah.
his latest moves have definitely caught my attention.
Yeah, he's been making some interesting bets, like loading up on shares of regional banking ETFs, ticker symbol PLE for those following along at home.
Interesting.
And he's also bought a big chunk of healthcare stock, Natera, ticker symbol NTRA.
Natera. Why those two? What's his angle, do you think?
Well, Druckenmiller's known for his incredible timing. You know when ChatGPT launched and everyone went crazy for AI,
Yeah.
he was one of the first to jump on NVIDIA. And when everyone was overly optimistic about interest rates, he was busy shorting bonds. The guy seems to have a knack for seeing the future.
So is he thinking the new administration might deregulate regional banks?
Possibly, that would definitely benefit them, give them a leg up.
And maybe Natera with its genetic testing is a play on the whole healthcare tech boom?
Could be. It's definitely a growing field. But here's the thing. We only get to see these filings after a delay.
Right.
And what works for someone like Druckenmiller might not work for everyone else.
That's a great point. We shouldn't just blindly copy trades just because a big name is doing it.
Exactly. It's about understanding his thought process, his approach to finding opportunities in a volatile market, not necessarily mimicking his every move.
Right, learning from the best, not just copying them.
Exactly. But it's still super interesting to see how a mind like his works, how he sees the world.
Absolutely. Well, we've covered a lot in this first part of our deep dive, but we're not done yet. There's still plenty to explore, including a surprising new study that's challenging the conventional wisdom about investor behavior. We'll be right back to dive into that, and more so, stick around.
Looking forward to it. So, before the break, we were talking about Stanley Druckenmiller.
Yeah, that investing legend.
Makes you wonder how his approach is so different.
Different from...
Everyday investors like you and me.
Oh, right, right. Yeah, I mean, it's easy to get caught up in the headlines
Totally.
and make decisions based on emotion, not like a solid plan.
That was the best of us. I'm guilty of it too sometimes. But, there's actually this new research. Super interesting study.
Yeah.
Really sheds light on how powerful our biases can be.
Biases.
Yeah, those behavioral biases, especially when we're trying to time the market.
Oh, man, trying to time the market, that's a whole other can of worms.
Totally. But I always love a good behavioral economics study.
Me too. So what did this one find?
Okay, so get this. They analyzed this huge data set of investor transactions going back like 20 years.
Wow, 20 years. That's a lot of data.
Right. And what they found was, well, kind of depressing.
Oh, no.
The vast majority of investors,
You mean like regular people?
regular people, professionals, doesn't matter. They consistently underperform the market.
I guess that's not super surprising.
Not really. I mean, we all hear that buy and hold is the best approach.
Right. Just stay the course.
But it's hard, isn't it? To resist that urge to tinker.
It really is.
And that's where it gets interesting. Because the study found that this underperformance.
You mean like not making as much money as we could?
Exactly. It's mostly driven by bad market timing.
Oh, so we're trying to be clever and it backfires.
Pretty much. Investors tend to buy high and sell low,
Mm.
driven by fear and greed.
So it's like we see the market soaring and we jump in thinking we're going to miss out.
Exactly. FOMO.
Right, and then things start dipping.
And panic sets in.
Sell, sell, sell. It's like an emotional roller coaster.
Totally.
Yeah.
And here's the crazy part. This happens even with experienced investors.
You mean people who should know better?
Right. They've been in the game for a while. But it just goes to show how powerful these biases are, like hardwired into us.
Okay, so if we know that we're prone to making these mistakes, how do we actually stop ourselves? Like, it's easier said than done, right?
Oh, it's definitely not easy.
Yeah.
But I think awareness is the first step.
Awareness.
Just knowing that these biases exist, it helps you recognize them when they're popping up.
She's like, hold on, am I really thinking this through? Or am I just reacting emotional?
Exactly. And having a solid investment strategy can be a huge help too,
So like a plan.
right? Something that's based on your long-term goals, your risk tolerance, not what the headlines are screaming or what your buddy at the gym is telling you to do.
Oh, yeah, because everyone's got an opinion. So it's like having a roadmap. So you don't get lost when things get crazy.
Exactly. And speaking of navigating a complex landscape, let's shift gears a bit and talk about something that's been making headlines lately. ESG investing.
Oh, ESG. Yeah,
Right.
that's everywhere these days.
It really is. It's gone from this niche thing to a major force in the investing world, and for good reason.
Because it's more than just feeling good about your investments, right?
Right. It's about recognizing that companies with strong ESG practices, they're not just doing good for the world, they're also setting themselves up for success in the long run.
Yeah, it's like that saying, doing well by doing good. But for those who might be new to this whole ESG thing, can we break it down a bit?
Sure. So ESG stands for environmental, social, and governance. And it's basically a framework for evaluating companies based on those factors.
Okay, so what does that actually mean? Like, give me an example.
So the E, environmental, that covers things like a company's carbon footprint, their efforts to reduce pollution, their commitment to sustainable practices.
So, like, if they're investing in renewable energy, conserving water, managing waste responsibly.
Exactly, all of that. Then you've got S for social, which is all about how a company treats its employees, its customers, the communities where it operates.
So things like fair labor practices, diversity and inclusion, ethical supply chains.
You got it. And finally, G for governance. That looks at things like a company's leadership structure, board composition, transparency, accountability.
So things like avoiding conflicts of interest, being transparent with their finances, holding themselves accountable for their actions.
Precisely. And what's really interesting is that there's more and more research showing a connection between strong ESG performance and strong financial performance.
Really? So companies that are doing good are also doing well financially. That's awesome.
It is kind of a win-win. And as more investors are embracing these principles, it's creating a virtuous cycle.
How so?
Well, companies are incentivized to improve their practices to attract capital, which then drives positive change in the world.
It's like a positive feedback loop. But let's be real. ESG investing isn't without its challenges, right? There's still a lot of debate about how to actually measure it.
You're right. Like, how do we standardize it? There's no one universally accepted framework.
And there's always the risk of greenwashing, right?
Yeah.
Companies just trying to make themselves look good, but not actually backing it up with real action.
Totally. So how can investors avoid those pitfalls? Make sure they're actually putting their money where their values are. It's tough.
It is. It's kind of a minefield out there. So what do we do? How do we know who's genuine and who's just trying to cash in on the ESG trend? That's what we'll be diving into in the next part of our deep dive. Stay with us. Welcome back to the Deep Dive. So before the break, we were talking about ESG investing.
Right. And how tricky it can be.
It really is. I mean, how do we know which companies are walking the walk?
Yeah, not just talking the talk, putting their money where their mouth is.
Exactly. So how do we navigate this? How do we as investors really know if a company is truly committed to ESG?
You have to look beyond the surface. Their website, their fancy sustainability reports, all that marketing stuff.
Oh, right, because anyone can say they're doing good.
Exactly. So you need to look for more objective measures, like independent ESG ratings.
Oh, are those like credit scores, but for ESG?
Kind of, yeah. There are organizations like MSCI Sustainalytics and CDP. They do in-depth assessments of companies, looking at a bunch of different factors.
You can compare different companies, see how they stack up.
Right, exactly. These ratings can help you weed out the pretenders, find the companies that are truly leading the way on sustainability.
Okay, so that's a good starting point. But we can also dig into a company's own disclosures, right?
Oh, yeah, absolutely.
Like read their sustainability reports, check out their policies.
Yeah, see what they're saying about their commitment to environmental protection, social responsibility, all that good stuff.
Right. And if something seems fishy,
Ask questions. Don't be afraid to reach out to the company, their investor relations department. Attend shareholder meetings. Make your voice heard.
it's about being an active investor, not just a passive one.
I love that. It's like you're putting on your detective hat, really doing your due diligence.
Right. And you know what else is exciting about ESG investing? It's not just about avoiding the bad guys.
Oh, yeah?
It's also about actively seeking out companies that are making a positive impact.
Exactly. Look for the innovators, the companies that are finding solutions to the world's biggest challenges.
Right, like in renewable energy or sustainable agriculture.
Or those tackling social justice issues. There are companies out there doing amazing things. Put your money behind them.
Yeah, invest in solutions.
And the best part is there are more options than ever before. Mutual funds, ETFs, even individual stocks.
So everyone can find something that aligns with their values.
Pretty much. It doesn't matter if you're a seasoned investor or just starting out. There's something out there for you. And, you know, a lot of people worry that ESG investing means sacrificing returns.
Right, that you can't do good and do well at the same time.
Exactly. But that's a misconception. Actually, there's growing evidence that companies with strong ESG practices, they tend to outperform over the long term.
Really?
Yep. So it's not an either-or situation. You can do both.
You can make money and make a difference.
I love it.
Me too.
And as we face these big global challenges, climate change, social inequality, ESG investing is just going to become more and more important.
Right, it's not just a trend. It's like a shift in how we think about investing.
Exactly. It's about realizing that our money has power.
That it can be a force for good.
I love that. Well said.
Wow, we've covered a ton of ground today. From Tesla and inflation.
To Stanley Druckenmiller and ESG investing.
My head's spinning.
It's a lot to take in. But hopefully you're feeling a little more informed, a little more confident about navigating these crazy markets.
Remember, knowledge is power. The more you understand, the better decisions you can make.
And don't be afraid to keep learning, exploring, asking questions. That's what it's all about.
That's what the deep dive is all about.
Couldn't have said it better myself.
Thanks for joining us, and we'll see you next time for another deep dive into the world of finance and investing.